Welcome to the second part of how to trade like a pro using the ADX. In this tutorial we will be primarily focusing on the DMIs. For a quick recap of the part 1, the following are the things that you learned how to do in the first part. Traditionally, the role of the DMIs is to be giving long and short signals using the Dmi crossovers. DMIs give a wealth of other information about price and momentum. The DMIs allow us to look at both bullish and bearish forces at the same time. This is something that is unique to the ADX and the DMI and not present in many other indicators. We're going to be covering the following topics in our lesson: the Dmi direction rule, the Dmi equilibrium rule, the Dmi expansion and contraction, the Dmi divergence and convergence, and the Dmi crossover strength. Understanding the DMIs and their relationship is a pivotal part of being able to use the ADX to its maximum potential. So let's get right to it. When the positive DMI is above the negative DMI, the trend direction is up. When the negative DMI is above the positive DMI, the trend direction is down. When the positive DMI and the negative DMI are below 25 and moving sideways, the trend has no direction. Expansion occurs when both the DMIs move away from each other, and conversely, contraction occurs when both the DMIs move towards each other. We are viewing with an example on Bitcoin how the concepts of expansion and contraction can be useful. So you can see that the first expansion that we have is not so big, hence the trend reflects weakness, where the contraction is also showing a Dmi crossover. And then you see when we have the second expansion, the price is also moving stronger and the DMIs are expanding further away. And you see that when they do contract, the crossover does not take place. Hence we are seeing a strength in trend and a continuation in the trend. In high volatility conditions, when the DMIs are further apart from each other, a Dmi crossover is a lagging indicator, which means that price moves first and the crossover comes in later. During periods of low volatility, that is, when both the DMIs are below 25, we will get a Dmi crossover which will be coincident with price. That is, as we do get a movement in price, we do get a crossover at around about the same time. Traditionally, Dmi crossovers are signals to go long when the positive Dmi crosses up and to go short when the negative Dmi crosses up. While this works often, it also fails frequently under many conditions. To avoid this signal to noise ratio, we have two strategies. The first is the Dmi Crossover High, and the second is the Dmi Cross and Hold. A long crossover high signal occurs when a positive Dmi crossover makes a higher opposite high above 25. Here you can see the last pivot that makes the lows and the positive Dmi that crosses over and makes a high above 25. A short crossover high signal occurs when a negative Dmi crossover makes a higher opposite high above 25. Here's the last pivot that makes a high, and here is the negative Dmi that makes a higher high above the pivot and crosses above 25. A cross and hold is the second type of crossover used for removing noise from our Dmi crossover strategies. The cross and hold is really a delayed crossover high. The DMI crosses up and fails to make a new high on the crossover swing, but it manages to hold above the opposite DMI. The DMI has the power to cross over and remain above the opposite DMI, but not enough power to make new highs. The cross and hold is considered to be temporary dominance. Our trade bias is with the dominant DMI, and it is a good setup for breakout trades. The DMI gathers strength before the breakout, and we usually see it pull back a little, but as long as the pullback does not cross back over, it is a good setup for taking that breakout. One of the things momentum indicators do is give us momentum divergence with price. DMI divergence is important for seeing areas of potential retracement risk for any asset. Over here you can see that all the red pivots with the positive DMI are showing divergences in this BTC uptrend. It is not necessary that each divergence will lead to a reversal, but a divergence is a place where you can manage risk and allow yourself to re-enter the trade when you have a signal for continuation. Conversely, you can see that DMI convergence means when DMI and price are in sync. As long as the DMI is making higher highs and the price is making higher highs, you can know that there is no change in momentum and the price is more likely to continue in the trend. In conclusion, when price and DMI are divergent, manage risk more closely. That may mean taking partial profits or tightening the stop. When price and DMI are convergent, stay in the trade, but still manage risk with a trailing stop. This concludes the second part of our ADX tutorial with an in-depth understanding and analysis of DMIs. We hope you enjoyed it. See you in the next one. If you found this video helpful, please give it a thumbs up and go ahead and share it with someone else. And if you have any questions about what we covered today, please leave them in the comments and I will be sure to get back to you or answer them in my next video. For more trading content and education, go ahead and click on the video on your right. Thanks for watching, guys, and cheers!